Hey, folks, we have with us once again Mark Collinsworth of Vere Global Financial Wealth Management to talk about the management of our wealth under the Biden administration. Now, on Friday, the latest job numbers have come out, Mark, and what does that say about where we're heading now economically with the jobs report? The jobs were pretty good, actually. So is that actually good or bad for inflation?
Well, thank you, Larry. That's actually bad news because people were actually expecting the jobs number to actually come down, but there's actually expecting people to lose jobs. That didn't happen. The unemployment rate actually dropped to 3.5. So technically, only 3.5% of the U.S. economy in the U.S. people are unemployed on 3.5%, which the Fed doesn't want to see that. Fed wants people to lose their jobs. And after the jobs number came out, the prediction from the Fed funds futures were predicting a 50% chance of a 25 basis increase. Now there's an 80% chance that'll be 25 basis points at the next meeting.
That's so the next meeting is what in May,
May 2nd and May 3rd.
May 2nd and 3rd. So probably another 25 basis points or a quarter of a percent rate increase from the Fed coming up.
Correct.
Again, that's to bring down inflation, but in order to do that, you say the game plan actually is for people to lose their jobs, massive layoffs.
Correct. In the Fed's eyes, the best way to decrease demand is simply to take money out of people's pocket. And the best way to do that, make them lose their jobs so there's no money coming in to replenish what they're spending. And people tend to stop spending when they have no job.
Now, what is the other ripple effect of this with the latest jobs report, with the anticipation of another rate hike from the Fed? What else is going on now with Wall Street and all that upon this news?
Well, the problem is that, the banking sector, Silicon Valley and Signature Bank, those banks went under because the Fed had raised interest rates so much so fast that it was actually basically causing their balance sheets to depreciate.
Right.
If the Fed keeps on raising interest rates, it's just going to make their balance sheets depreciate more, and that puts a problem on it because their asset levels go down. They technically become insolvent, and then as the Fed raises interest rates, that makes investments like T bills, like right now in your bank account, you may only be getting like 0.1, maybe 0.2%. Why do you want to get 0.2% when you can go buy a T bill, a 6 month T bill, and earn 4.8%? And after the Fed raises interest rates here in another month, that 4.8 is going to be 5%, earn 5% in a U.S. Treasury bill. Wow, that's pretty good.
So again, we're marching towards at least a moderate and perhaps a severe recession.
I don't know if it's going to be a severe recession, but you're definitely headed towards the recession way, which is interesting. If you look at the spread between the 3 month yield and the 10-year yield on bonds, they're at their largest spread now. The 3 month is so much greater than the 10-year, which is usually a very reliable sign of recession. It's at its largest spread in over 40 years now.
All right, Mark, switching topics here now, actually related. There's more and more talk now among the various news outlets of the dollar losing its reserve status. Now, up until now, that was considered something way in the distance and a remote possibility. But now there's a lot of talk in various news outlets. So what's that all about?
Well, let's back up and explain reserve status. So,
Yeah.
right now, today, all oil in the world has to be traded in US dollars. If France buys oil from Saudi Arabia, has to be paid for in US dollars. So every country in the world has US dollars on their balance sheets as a government to buy that oil. The best way that they go about getting that cash on their balance sheet in US dollars is to buy US Treasury bonds. That's why so many people buy US Treasury bonds from around the world is they want that dollar-based currency that they have to buy oil with. If there is a competing currency that you can trade oil in, and that's what the Russians and the Chinese are trying to do, is create a currency that allows oil to be traded in something other than the US dollar. And as of right now, there's 7 countries who have agreed to actually trade oil in something other than the US dollar. Once the US loses that dollar status, there won't be as much demand for people to buy bonds. That means interest rates will have to go up to attract them to the US dollar. And as interest rates go up, it'll be harder for the United States to issue more debt because those people in those other countries won't want to own the debt in a US dollar. They'll want to own the debt of the other country that you can trade the oil in.
Is that catastrophic when that happens?
It's not catastrophic in the short term, but if you go into recession, because the two ways the government deals with recessions is they cut interest rates and they issue more debt, government spending. If the Fed cuts interest rates, won't do any good because people are still going to want to buy those the currency, the other currency, and the United States government can't issue more debt. Well, they can, but it'll be difficult because they'll be paying a much higher interest rate on that debt.
The domination of the U.S. up until now of the global economy has been largely based on the dollar having that reserve status, correct?
That's correct. In economics, it's actually referred to as milkshake theory, that the country that has the most inflow of capital into it theoretically should become the dominant player on the economic front. And the reason why so much capital has come to the United States is because people want to own stuff dollar based because they have to buy oil in. Everybody needs oil. If there's another country, let's say China, has a currency that trades in dollars, there'll be a more influx of money flowing into China than there has been previously, and a less inflow of money into the United States. And according to milkshake theory, that will propel China to a whole nother level of economic strength.
That's a big economic trading block then.
That's a big thing because from Brazil, we do a lot of trading with Brazil for commodities, and then of course Saudi Arabia. We basically the United States acts as Saudi Arabia's military. Basically, when the Gulf War invasion, Saudi Arabia was scared to death that Saddam Hussein was going to invade Kuwait, was going to invade Saudi Arabia after Kuwait, and whose army basically went over there and stopped the entire thing. It was the United States. A lot of people don't realize this, but one of the largest naval bases in the world is actually in the Persian Gulf on an island, basically protecting Saudi Arabia from foreign invaders.
So would you say that Biden's economic policies are causing this drift away from the dollar's reserve status and the whole economic mess that we're in?
I would probably say it's partly his economic policies, more to the point, it's a lack of backbone. When you have a leader that has no backbone, other countries just tend to run over them everything. If you had a really strong leader that the other countries really respected, they would basically say, no, you're not going to do that. We can come to a deal, but you're not absolutely not going to do it. And you don't see that happening here because Biden's just a pushover.
Well, is that design, or is it just his constitution? I mean, is there a method to what we see as madness?
Um, I think it's a combination of all those things. Um, that's one thing I hate about politics is in today's politics. And I always, if you look back through history, and if you ever watch the movie Game of Thrones is a really great aspect on how politics should actually work. The person that should be the leader, the best person that should be the leader, should be the person in the leadership role. It's not based on a popularity vote or how much free stuff. It's actually based on who does the best job for the benefit of the people under them. And they will do anything they have to do to get that position. Here in the United States, it's a popularity contest. That doesn't mean you're a good leader. You got there because a bunch of people voted for you, not having a clue to what's going on.
Well, I mean, there's so much assumptions that Biden really isn't running the administration. There's other people behind it, around him, that are really calling the shots.
I can see that, and that happens to a degree in every administration. I think this administration is probably happening a whole lot more, and those people are simply basically writing policies and procedures just to put more money in their pockets.
Janet Yellen, our Treasury Secretary, says, don't be alarmed about the drift away from the dollar, the reserve status of the dollar. Now, so what's she saying, that it's no big deal?
She's saying it's no big deal from the standpoint that in the short term, it's not a big deal. But long term, it's going to have very, very bad implications for the United States as an economic power.
But she says it won't happen for a while. But even that is quite an admission, isn't it?
Correct. And when she says it won't happen for a while, what I think she's referring to is you have all these countries that own all these U.S. Treasury bonds on them, right? And in the past, when those Treasury bonds matured, let's say $1 trillion matured, they simply went back and they bought another $1 trillion. So the United States government didn't have to worry about that $1 trillion because they just simply rolled it over again.
Yeah.
If the country goes to another country gets reserve status, they're going to let those bonds mature, that $1 trillion, say, for example. And this time, instead of them just putting that $1 trillion back in the United States, they're going to take that $1 trillion and put it in another country. Well, the United States now is going to have to pay that $1 trillion in principal, which they never had to do in the past. They're going to have to issue $4 or $5 trillion now to keep the government running, plus pay the principal back on the bonds that actually matured. And that's going to be a problem because it's going to have to be principal is going to have to be paid, and the new bonds that are issued to pay that principal will be issued at a much higher interest rate.
Yeah, there seem to be increasing indications that it will be China's century. By the end of this century, China will be the dominant economic and perhaps military power globally.
I can definitely see that. In the United States, for some reason, the United States culture, we like to think, our planning status is, 1 quarter, 2 quarters, maybe 3 quarters into the future of the year. In the Asian culture, when they do their planning, they plan for a quarter to a half of a century into the future on their planning process, and that's a huge disadvantage to the United States.
Well, again, a glum note from Mark Collinsworth of Vere Global Wealth Management. So we'll see what the future brings. Let's keep our fingers crossed if that'll help at all. So, Mark, thanks once again for your predictions.
Well, thank you, Larry. And always remember, like I always say, it's always the darkest before it goes to hell in a handbasket.
Mark, sign off. Okay, Mark. Talk to you later.